Right now, in 2026, millions of Americans are collecting less Social Security than they earned, not because they made a bad decision, but because nobody sat down and explained the rules that apply to their specific situation. And here is what makes this particularly serious. The mistakes I am about to walk you through are not temporary. Most of them are permanent. Once you lock in a claiming decision, that number follows you for the rest of your life. Social Security does not apply the same rules to everyone. Your full retirement age, your penalty for claiming early, your options for getting money back, all of it depends on the year you were born. So today I want to do something direct and practical. I am going to walk through 4 birth year groups one at a time. Find yours, listen to what applies to you, and by the time this video is over, you will know exactly what to check and what to do about it. Let's walk through this together step by step. The first group is people born between 1,943 and 1,954. If that is you, you are somewhere between 72 and 83 years old right now. You have been collecting Social Security for a while, and most people in this group assume there is nothing left to check. That assumption is costing some of you real money every single month. The most important thing to look at if you are in this group is whether you are on the right benefit in the first place. A significant number of widows and widowers in this age range are still collecting based on their own earnings record when they would actually receive more based on their deceased spouse's record, or the other way around. The survivor benefit can be as high as 100% of what your late spouse was receiving. In many cases, that amount is substantially higher than what the surviving spouse is drawing on their own record. If you lost your spouse and you never specifically asked Social Security to compare both options and put you on the higher one, there is a real possibility you have been leaving money on the table for years. The fix is a phone call. You call the Social Security Administration and you ask them to pull both numbers and compare them directly. You did nothing wrong. The system just does not tell you this automatically. The second thing to look at for this group is Medicare specifically, a surcharge called IRMAA. If your income was higher in a previous year due to a one-time event like selling a property, converting money into a tax-advantaged account, or any other single-year spike, Medicare may still be charging you extra based on that old income figure. These surcharges range from about $70 to nearly $500 per month added on top of your standard Part B premium. There is a correction form, the ssa.gov, designed specifically for people whose income has since dropped because of a life-changing event. If you are currently paying more than $185 per month for Medicare Part B, it is worth asking why and whether you qualify to appeal. Now, I want to pause here for a moment, because what I am about to cover in the next 2 groups is where the stakes get even higher. I am going to show you the exact dollar cost of common claiming mistakes. A little-known option that can put a lump sum of up to $12,000 in your first check, the income test that can make your benefits seem to disappear without explanation, and a records problem from the 1980s and 1990s that may already be quietly shrinking the benefit you have not even claimed yet. If you want to go even deeper on all of this, the full mechanics, the forms, the timing decisions, I put together a resource called the Hank Sullivan Retirement Protection Pack. You can find it at hanksullivan.net.lifi.app. The link is right there in the description, or you can scan the QR code showing on your screen right now. It goes into more detail than any single video can. Take a look when you are done here. Now, let me show you something that almost nobody in the next group knows about their own situation. Group 2 is people born between 1,955 and 1,959. You are between 67 and 71 years old right now, and this is the most critical group in 2026 because the rules are actually different for each individual birth year within this range. And the vast majority of people do not know their specific number. Here is the full breakdown. If you were born in 1955, your full retirement age is 66 years and 2 months. Born in 1956, it is 66 and 4 months. Born in 1957, it is 66 and 6 months. Born in 1958, it is 66 and 8 months. Born in 1959, it is 66 and 10 months. That is your number. Not 66, not 67. Your specific month and year. Let me do the math live so it lands. Say you were born in 1957, which means your full retirement age was 66 and a half. If you filed at 62 instead, your benefit was permanently reduced by approximately 25.8%. on a benefit of $2,000 per month. That is $516 gone every single month. Spread that over 20 years, and you are looking at roughly $123,000. Social Security processes the application. They do not stop you and say, "Are you sure you understand what you are giving up forever?" They ask if you understand your benefit will be reduced. You say yes, and that reduced number becomes your permanent amount. On the other side of that same coin, for anyone in this group who has already passed their full retirement age and is not filed yet, every month you wait beyond that age adds 2/3 of 1% to your benefit permanently. That works out to roughly 8% per year. Between full retirement age and 70, you can accumulate somewhere between 24 and 32% more per month for life, depending on your exact birth year. On a $2,000 benefit, that is potentially $640 more every single month permanently. And for people in this group who are currently working while collecting before full retirement age, there's something called the earnings test. In 2026, if you earn more than $23,400 for the year, Social Security will withhold $1 for every $2 above that limit. Now, that money's not gone forever. It gets credited back to your record once you reach full retirement age and your monthly benefit gets adjusted upward. But if you do not know this rule exists, that withheld amount can feel like your check just vanished without explanation. Social Security and tax rules change every year, and nobody from the government calls to explain what it means for you specifically. That is exactly what this channel is here for. Subscribe and turn on the bell so you catch these things before the deadline, not after. Group 3 covers people born between 1,960 and 1,965. You are between 61 and 66 right now. For everyone in this group, full retirement age is exactly 67. And the most important thing you can do right now is understand in concrete dollar terms what filing before that age actually costs you before you make any decision. Take someone like Margaret, a 63-year-old retired school cafeteria worker from Central Ohio. She is thinking about filing now because money is tight and 62 feels like a long time ago. What she does not realize is that filing at 63 with a full retirement age of 67 locks in a permanent reduction of roughly 25% on a benefit she has spent a lifetime earning. On a $2,000 monthly benefit, that is $500 less every month for the rest of her life. Over 20 years, that adds up to $120,000. If she files at 62, the maximum early filing penalty, the reduction is 30% permanently. That is $600 less every single month over a 20-year retirement. That is $144,000 compared to simply waiting until 67. The Social Security Administration will process that early application without warning her. They ask whether she understands her benefit will be reduced. She says yes. And that is that. But here is something almost nobody in this group knows exists. If you file after your full retirement age of 67, you can request up to 6 months of retroactive payments. Social Security treats your filing as if it happened up to 6 months earlier and pays you a lump sum for those months. On a $2,000 monthly benefit, that is a single payment of up to $12,000 with your first check. There is a trade-off. Your ongoing monthly amount will be slightly lower because your official start date moves back, but the option exists and almost no one asks for it. For people in this group who are still 5 or 6 years away from being able to file, the single most valuable thing you can do right now is open your Social Security earnings statement. Go to ssa.gov, create a My Social Security account if you do not have one, and pull up your statement. Look at the income listed for every single year you worked. Compare it against your own records, old tax returns, W-2 forms, anything you have. One incorrect year, one employer who reported the wrong payroll figure in 1995, one period of self-employment that never got properly recorded can reduce your monthly benefit by around $100. Find it now while you still have time to fix it, rather than discovering it after you have already claimed. Which brings me directly to the fourth group, and this is where the long game either pays off or quietly falls apart. Group 4 is people born in 1966 or later. You are 60 or younger. You are not close to filing yet, and that is precisely why what I am about to tell you matters so much, because the window to fix certain problems without it costing you a dime is still open. It will not stay open forever. The fixed numbers for your group, full retirement age, is 67. Filing at 62 means a permanent 30% reduction Waiting until 70 means up to 24% more than the full benefit, permanently. Those figures are already set. What is not yet determined is whether your earnings record is accurate. Social Security has been recording your payroll data since your very first job. That data came from your employers, and every single year there was a chance something went wrong, a wrong number submitted. A year skipped, a period of self-employment that was not reported correctly. Each uncorrected error reduces your eventual monthly benefit by roughly $100 for every year that is missing or wrong. If you worked during the 1980s or 1990s, when payroll was processed manually, there is a real probability that your record has at least 1 year that does not accurately reflect what you earned. And here's the problem with waiting. The documentation that fixes these errors, old W-2S, pay stubs, tax returns, is easier to locate today than it will be 15 or 20 years from now. The solution is straightforward. Go to ssa.gov, open your earnings statement, and compare the income listed for every year against whatever records you have. If something does not match, you can submit a correction request with your supporting documentation. Social Security processes those corrections and updates your record. It costs you nothing. Do it now while the paperwork is still findable and while the fix is still free. Let me bring this all together for you. If you were born between 1943 and 1954, check whether you are on the right benefit, especially if you are widowed. And look into whether you are being overcharged on Medicare through an IRMAA surcharge, because there may be an appeal available to you. If you were born between 1955 and 1959, find out your exact full retirement age down to the specific month. Understand the permanent cost of filing early in real dollar terms. And if you are currently working while collecting before full retirement age, make sure you understand how the earnings test works so that withheld money does not catch you off guard. If you were born between 1960 and 1965, put the 30% early filing penalty in dollar terms before you make any decision, and find out whether the retroactive lump sum option applies to your situation. If you were born in 1966 or later, open your Social Security earnings statement today at ssa.gov and go through it year by year while you still have the documentation to back up a correction, and while fixing it costs you nothing. Now, I want to be clear about something. I am not a licensed financial advisor, and nothing in this video is personal financial advice. Every situation is different, and for decisions this permanent, it is worth talking to someone who can look at your specific numbers. What I can do is make sure you know what questions to ask and what to check before you walk into that conversation. The system is not designed to flag these things for you. It never sends a letter saying, by the way, you might be on the wrong benefit, or here is an option you probably did not know about. You have to know to look. That is why I am here. If any part of this applies to someone you care about, a parent, a sibling, a neighbor who is getting close to that decision, please share this video with them. This is exactly the kind of thing that makes a difference before the decision, not after. And I want to hear from you directly. Which birth year group are you in? And was there anything in this video you had not heard before? Drop it in the comments. I read every single one.